Hello and welcome to the Relax. It's Retirement Podcast with your host, Josh Leonard, where we talk about transitioning into retirement with intent. I'm Wendy McConnell. We have Pete Belcastro, one of our recurring guests here on the show. How is everybody doing? Don't all talk at once.
Yeah, I was going to say, I'll jump in. We're all full and lazy and maybe a little bit tired.
Because it is right after Thanksgiving.
It is. We are recording it the Monday after Thanksgiving. So, yeah, for reference, we are fresh off of that gravy boat.
That's right. It does feel good to be back, and I'm glad you didn't call us jive turkeys. So we're good to go.
The episode is young. So the election's over. Would you say that we are in a bull market right now?
We are currently still in a bull market here, Wendy. So, I think after there was a lot of speculation rolling up to the market, lots of, I don't knows. And then after the market, there was a pretty big pop, or after the election, there was a pretty big pop in the market. So, there was, a lot of money that went into the market to the tune of like trillions of dollars. And I started looking into it and talking with Josh, and we kind of went back and forth and talked about an article, and it was like, okay, what's causing this, and what causes the fluctuation? And usually, what causes fluctuation, Wendy, is the unknown. So after the election, we went from an unknown to a known. So a lot of the research that we do is it's showing that that's where the market gets its power, is these known factors. So now we get to the next step, which is, well, we know what goes up must come down. This thing can't last forever. So what do we think is going to cause the next recession, or what are the factors out there that can cause the stock market to start going down? So what we're talking about is going from a bull market to a bear market here.
Pete, what's a bull market?
Hey, thanks for asking, Josh. Bull market is it's an upward trend in the market. So it's whenever prices are increasing. Investor confidence is in a high. So we see the people's investments are going up, and a lot of what our market is driven by is consumer spending. So people are still spending the money. So it's an area in time whenever everything is appreciating and the market is going up. So not necessarily it makes everybody feel like everything is going well, but the stocks, the prices, the indexes that we use, large companies in our economy, all of their prices are increasing.
So I have a question. Now that the election's over, we're not really sure how some of these policies are going to affect it. Is it now when we would start to see a downward trend, but instead we're seeing up?
So, yeah, I think, Pete, one of the articles that he had pulled referencing was, hey, the market is happy because at least they know who the president is going to be now. So there was uncertainty, certainly through our last election cycle. There was a lot of doubt and everything. We know who's going to be in office. I think that's clear. I'm sure some people are still arguing about that, but whether you're happy or not could be a separate thing. Donald Trump will be president again here. We know that. So at least the market knows moving forward, hey, this is what he said he wants to do. Now, some of it might not seem like it's possible, due to various constraints, but at least the market knows the direction in which things are going. So, hey, in terms of businesses planning for 2025 and beyond, hey, we are going to tailor assuming these types of policies to our business plan moving forward.
Okay.
Yeah, so not necessarily, we don't really look at who's in office really, whenever we start looking back. It's more what could cause this thing to start to go down? What could cause our investments to start to lose money? So whenever we are close to the top, which there's no doubt, I mean, the market's breaking records, so we're closer to the top than the bottom. So you have to start thinking about what is this recession. And last year, once we wrap up a year, I tend to start looking at where we were the previous year. So back in 2023, there was almost an 85%, so a pretty good chance that we were going to see a downturn in the market this year. Okay. And if you look at some of the indexes, some are up over 30%. So I'm here again, and we see a lot of things that are saying, hey, there's a lot of positive things in this market. There's some things that could happen that could boost businesses, that could keep people spending money. And it kind of gave me a little pause, because I'm reviewing my notes from last year to say, hey, how could this thing go down?
Yeah, I think the market is always fearful of certain things happening, right? And I think that there's certain factors that can trigger the bull to change to a bear, which we'll talk through today. But we never know. And to your point, Pete, like last year, looking at the year ahead, it looked like we were probably going to go through some sort of substantial pullback. And we're hitting record highs again, way above average return on all the major indexes. So fantastic. Let's make sure that we're positioned to benefit, even if there are some concerning factors within the plan. So, I think today we wanted to cover some of those key points that can cause a bull market. I think the first one we had on the lineup here is recession, right? I mean,
that's right.
What's a recession, Pete?
Yeah, so this is what we're talking about, is a down, a time in our economy where GDP is starting to go down. So that's, consumer spending, that's one of the biggest factors that starts to trigger a recession. So we're talking about, this is something that's not short. So it's not like, hey, people stop spending this week. It is over a period of time. We like to consider. Usually we wait at least, a quarter, but really it's 2 quarters of, negative GDP. Those are some of the indicators that we are in a recession. They usually last, like I said, those a couple of months, and we see rising unemployment, and people start getting nervous out there, and you'll feel it yourself too.
Yep. Yeah, I think from a business perspective, if you see, hey, you know what, consumer spending is slowing down, maybe if you're a manufacturer, you stop making as many goods. If you were thinking about hiring people, maybe you slow down on that. So it can kind of cause a cascading factor in which then the stock market moves along with it, right? If unemployment if unemployment is higher, less people are employed, well, okay, maybe there's not going to be as many people contributing into the market through their 401k if they're not working, right? They might be pulling that money out. So sometimes those can kind of compound. I think on recessions, we can see the likelihood of a recession coming is more likely after we've had consecutive positive years, right? Things have built up pretty high, and then a recession is often kind of a reset.
Absolutely. And we tend to see, the prices of things start to increase when we start getting close to, a bear market. So, we're in a bull market, everything is going up, and we see inflation, right? So we've experienced that in the past few years, and then the Fed even told us that, hey, inflation is on its way down. So that was another interesting factor that came into play this market cycle, because we had them raise interest rates. Inflation was 9% at one point, and it didn't trigger a recession. So so that it's a factor, but not every one of these factors is going to cause the stock market to go down, which is why it's so hard to predict.
Yeah, I think inflation was a big thing in a lot of the predictions for this year of why the market would go down is, hey, you know what? We've been really hit with this high inflation. Certainly we hear it from clients all the time. If you go anywhere, I mean, we had talked about eggs on the podcast before, Wendy. I know the necessity in your diet of eggs, and that certainly hurts. We've all been impacted by that. Luckily, though, we've seen to outgrow it, too. So inflation this year has started to slow down. Again, reminder, slowing inflation doesn't mean eggs go back to 99 cents a dozen, it just slows the growth of the price of eggs. So we've seen that kind of slow, but at the same time, with the market up over 30%, well, inflation's not all that bad. It's not really eroding the value of the investments. Instead, the investments have kind of kept pace or exceeded to help you continue to grow your wealth, which is a great reason to stay invested.
Yeah, absolutely. Absolutely. And obviously with those, with inflation, one of the factors that leads to inflation is rise in interest rates. So if you tried to get a loan lately, and the last time you tried was 7 years ago, you're going to have some sticker shock. The feds are the raised interest rates. I mean, mortgages, geez, you're talking 8%, which, you talk to some people back in the 80s, that's not too bad of a rate. But we see the interest rates start to increase. The cost of borrowing is high. The Fed is trying to tighten money, so they think that things are taking off too much. So they don't want money to be as easily accessible, and that typically could help start to trigger a downturn in the market. We saw rates get cut here at the end of the year, but at the same time, the stock market continued to rise. So.
Yeah, I think, the cost of borrowing, certainly from the household perspective, if you're looking to buy a house now versus even, in 2020 or 2021, your cost is substantially higher. We have moved quite far away from the 3% or less mortgage. For businesses, it's the same, though. If you're looking to expand operations, maybe into a new market, and you need to take out some debt to do that, it costs more money now. So, in theory, that should really slow down the economy a lot more than it has through this rate. So that was sort of the battle that the Fed has had. We seem to have overcome this high interest rate environment, market-wise, just as we have with inflation, which, those things kind of go hand in hand. So, the Fed plays a role in all of that. So I know one of the other points here that we had tightening monetary policy. So the Fed influencing the market there as well.
Yeah, they start to make it harder for individuals, or especially like Josh said, businesses to get money. It's gonna be tough on everybody. And if companies can't get money, or let's just say they get money at a rate that's too high, that could lead to some defaults. We all know our own credit report. If we miss payments or we don't meet our obligations, our credit score starts to go down. Believe it or not, companies have those. Municipalities have those. So once we start seeing all these things start to get cut, and people are defaulting, it happens with countries as well. And I think this is kind of getting to the part that we haven't seen yet, Josh or Wendy, is that we haven't seen a good deal of countries, their credit ratings start to get cut. So these are all factors that are, almost from the book about, hey, what causes a recession? And as we go through these, it's like, well, that one didn't cause it. That one didn't cause it. Well, this one didn't happen yet. And, it kind of leads us, I didn't know. Do you have anything to add on the credit ratings, Josh? Because that's...
Yeah, I mean, back in 2011, the U.S. was downgraded. Our debt, if we look at that in terms of just the economy ticking along, it's very important that U.S. debt is considered very stable. So if major economies start having downgrades in their credit rating, so a credit rating system is just saying how stable is this? Now, right now, short-term U.S. debt is considered about the safest thing in the world, right? The whole government would have to collapse in order for that debt to not be repaid. Now, if I borrow money from my neighbor, that is reliant on me earning money and being able to give that money back to him. If we are, I'm as much as I like to think my finances are stable, they're not as stable as the U.S. government. There's not enough backing behind that. In terms of our economy as a whole, we utilize that for oil trade, for consumer trade throughout the world as well. So whenever you start taking major economies and cutting their credit ratings, that can have a echo throughout the world economy. So that is a very serious factor. I think as you take on more debt, it becomes more realistic that you're going to default, right? If you open up 20 credit cards and start maxing them all out, at some point they're going to say, Pete, cut it out, man. No more credit cards.
Time to pay the piper. Yeah.
Yeah. Or like you'll see, I've seen a lot lately because, this is what I do on social media. I see like car debt loans. And it'll be like, oh, I took a 6-year loan out on a 10-year car and it's only $500 a month. And you're like, oh my gosh, your interest rate is killer in that. Well, they're only loaning you that because they know they can make enough money when you inevitably default on the payment again shortly down the line. So, all of these things, this credit rating certainly has a lasting impact. That is a major indicator that we would go through, a pretty massive recession if large economies' credit rates just get wiped out or lowered substantially. So we want to be careful there. I think in terms of credit rating, like the U.S. economy can take the U.S. credit rating can take a couple steps down before it's not considered investment grade.
I have a question about the recession that has not been. We seem to have a lot of the issues that you guys are talking about, yet we really never went into a recession in the last year. Like, what is the explanation? Are you getting to that? Am I jumping the gun? I mean, like, tell me what's going on here.
It's that. I mean, there's been a variety of factors that of why we haven't seen a downturn in the market, and really, like I mentioned, it's you and I, Wendy. It's people willing to spend thousands of dollars to go to concerts. It's I know, it's
I wasn't listening.
oh no, sorry. Not anybody here, but it's. So
Taylor
it's
Swift's economy. Is that what you're telling us?
Yeah. So people are still spending right now. It makes up over 85. That's right.
Sorry.
That's okay. Sorry. But really, consumer spending has not slowed down. People are still going out to eat. People are still, I believe, in this mindset of this COVID mindset that, hey, you're going to die tomorrow. You got money in your bank account. Go out to eat. And I think that we're starting to see a little bit of cracks in that because, let's just say that everybody's savings account in America was like here before the recession. After the recession, it was a record high. So people got more money, and now we're below 2019 levels of savings. So that I believe is one factor that hasn't crept into it. And a lot of these things could have kind of a waterfall effect. I don't know if you've ever seen those people that have like a one domino that's like, a couple ounces, and on the other side, they have something that's thousands of pounds. And, the dominoes just gradually get bigger, as it falls. That's kind of what happens here with some of these things with the recession, is that it's not an equal domino, hey, this one falls and this one. No, it's this factor triggers a bigger factor, which triggers a much bigger factor, and that would continue, and which kind of leads me to why, I was bringing this up with Josh, and why I wanted to talk through it and put it out there is because we're starting to see people have a lot of exuberance. There's a lot of excitement in the market, it's not like it's a concert that everybody starts feeding off each other, and now that this person's clapping and the other person's clapping and they're all cheering, and then you're exchanging friendship bracelets, and it's a great thing. This is more like the speculation starts building, and people are getting too excited, and they're taking out more than they should. They're investing in places that are they know little about. For example, we've seen that cryptocurrencies are having a pretty good run here. They're in the headlines, and now somebody feels like they're going to miss out if they don't invest in these things. and they're willing to take a huge risk to do that. So when something, we have Bitcoin getting to over close to the $100,000 a Bitcoin number, where people are paying pennies for them, when they first came out, and there's a big fluctuation, and people are still willing to put money into that. These are some things that they start overvaluing companies. They start putting things out of whack. So why, so that's right. Why is that a bad thing? If we're all putting money in, the thing's going up, everybody's having a great time. This is why, because with that same enthusiasm that people go into the market, they're going to exit the market. They're going to pull their money out. So, hopefully, this kind of ties it a little bit more together, is that if you just look in the short term and you just look at the past month of what happened to a recession, and you start making your investment decisions based on that, it's going to be real easy for you to justify, making decisions when bad things happen and getting out of the market too quickly.
Yeah, I think many times the market gets overexcited, and consumers do too. And there is the FOMO that Pete's talked about a lot. We did a podcast on that. He has a great Kiplinger article that discusses FOMO and that fear of missing out. But that's what too many people do investing. They say, oh, Bitcoin's at an all-time high. Let me buy in now. And then the price erodes. And now that $100,000 is now worth $50,000. And I lost half the money. I better sell it before I lose all the money. And then, eventually, I don't know about crypto, but in terms of stable companies, that price would then go back up, or the market as a whole over time. But people aren't patient, and sometimes they get too excited on up-and-coming trends. I think the dot-com bubble is the easiest one to kind of play back out. It's been a couple years now, and guess what? We do everything online. And guess what? There's a lot of people that buy all their pet supplies online. But it wasn't pets.com. It's now Chewy or Amazon or some other company that has filled in that place. I think pets.com was kind of a famous example of a ramp up and a complete failure. The idea behind the investment was good. It just wasn't the exact right company. So, hey, the trend itself was good. And if you stayed invested the last 20 plus years, and if you owned a little piece of Amazon with a bunch of companies that failed, you would have done really well. But most people weren't patient. They bought in, and then it crashed and they sold everything, or they invested it all into one company. They weren't properly diversified. A lot of these ongoing investment things that we talk about, and it caused a problem. So right now, I think that's it. It seems like we're in the cycle of everyone's really excited, so we're going to put money into it, and then, at some point it'll decline. That doesn't mean that it's the end of the world, but
More to come. Yeah.
gets a little bit too excited too early.
Yeah, it's just one of these. So we're seeing a couple indicators that we have not seen yet, that once we do, we could see some pretty significant fluctuations. And, and so a lot of the clients that we work are people transitioning into retirement, and we want to, make sure that they get there and they stay there. And these feelings of this FOMO feeling doesn't go away with age. I think I could remember talking to my grandfather, to his mid-90s about, missing investments, should I get into this? And I'm like, Pap, you're fine. Everything's taken care of forever. You don't have to worry about it. Keeping yourself to your long-term plan, making sure that if you do see something out there that you feel like you're going to miss out, does that matter? Mm-hmm. Is it worth losing what you have to get maybe a potential return? Are you going to live any differently? All of a sudden that you made 500% return, are you going to go out and buy that car that you didn't buy before, or those pair of shoes, or go see that concert? I don't think so.
Wendy's like,
you might not.
Pulling up in the Lamborghini.
I don't know what you mean. I would do whatever you told me to.
There you go.
Right. Okay. Right answer. I think we do find, though, a lot of our retired clients were oftentimes like, this is the rate of return you need to have success. Success being not running out of money till age 100, leaving a legacy, whatever you define that as. What do we need to take more risk than that, right? We don't need to risk what we already have for what we don't need, right? Most of our clients, once they do retire, they're pretty established in a lifestyle. I joke all the time, like, well, you're fine as long as you don't decide to go buy a Bentley next week. But you know what? If you've drove a Toyota Camry your whole life, you've probably justified that type of vehicle in your mind for 30 plus years to suddenly go to something that's expensive to maintain, expensive to repair, that you're going to have a heart attack when the grocery cart hits the door. You're not going to do it. It's out of people's normal behavior. So this idea of we need to take the long shot to have success is not really there. If you want to explore investments, for me personally, I like investing a little bit into new things to follow it, to kind of have something in it, but it's a small piece. It's not 100% of the portfolio. In fact, it's always far less than 10%. With clients, we say never more than 10% into one investment. That way, even if it completely collapses, well, you still got 90% there, right? But, these things you need to think through. You can't expect a magic bullet or the silver bullet from one individual investment, right? You have financial success in retirement by saving prudently for many years and allowing that to compound. As we transition into retirement, it's important to have our 3 buckets there, to have enough cash in the short term that if the market goes down, we can pay our bills. If the water heater starts going, we can replace that. Having our income bucket where we have that 6 to 10 years set aside in pretty stable investments, so we know that the money's there to spend for our regular expenses over that time period. Then the rest we can grow. But that doesn't mean put the whole growth bucket in Bitcoin. No, it means still having a properly diversified portfolio, just most likely more invested in stocks or something with a higher risk profile.
Okay.
So, in terms of when the market's going to crash, Wendy, I will tell you at some point it will. And I think Pete will second that. We cannot tell you the exact date, but it will at some point.
That's correct. We know fluctuation is coming, so just be ready for it. There you go. Yeah, that's right. Yeah, look forward to it. In fact, there are, yes, love to talk about people why you should look forward to recessions here. That might be the next one here, Wendy. Cool. And yes, look for those factors, and I think that just stay grounded. Don't. Like I said, look between the lines with some of these things, especially what's going on right now with some of these, semiconductors and these Bitcoin, these cryptocurrency stocks. There's always going to be something like that that somebody's always going to make a 1,000% return. And I always say that the person in front of you, and if they just won the lottery, on a scratch off, they're probably pumping double that back into scratch offs. So don't try and compare yourselves to somebody that you think might have had a big win. They might have had to pay a great deal for that.
Yep, absolutely. Yeah, I think like we always talk about, the key to proper planning is patience, setting up the structure and letting it develop over time. We know that market fluctuations will happen. There are a lot of indicators that we look at, but many times the biggest risk to the market is one that we can't see now. We saw that recently through COVID and then interest rate hikes. These things will always happen. So if you're not working with a financial advisor at Leonard Advisory Group, that's exactly what we do. We help lay out that plan and that foundation so you can transition into retirement with intent and stay retired. If you are looking for a little bit more information, we put together our 7 big retirement mistakes checklist. You can download that in the show notes. If you're making 3 or more of those mistakes, we'd encourage you to call us and get your plan back on track. In our next episode, we're going to talk through the gift of giving, how to make a difference in retirement during the holidays. Now that we've rounded the corner around Thanksgiving, we need to start thinking about giving. So we'll talk about some great strategies to do that. Until next time, remember to retire with intent so you can live your golden years with the happiness and excitement you deserve.